Okay, and we're recording. Good afternoon, everyone. I'm Mary Griffin with the Cooperative Development Foundation. Introduce us and our work, we are an 80-year-old national nonprofit with a mission to promote cooperative and other mutual aid, education, and development across all sectors and industry. For the past few years, with primary funding from Robert Wood Johnson Foundation, we've been involved in advancing shared equity housing. This work has involved three areas: outreach and education, identifying what enabling environments can help scale these models, and where there is potential to scale. And the third is informing an outcomes measurement system to help demonstrate how shared equity housing can advance housing stability, racial equity, and other outcomes. We've been hosting convenings, webinars, site visits, talking to people all over the country. And one issue that comes up again and again is the cost of insurance and how the cost of insurance has created problems for moving projects forward in shared equity, problems for homeowners. And we hear that people like to hear more about these, how the industry works and some of the potential solutions. So today, that's our topic. And to help inform you about this market and the potential solutions. And before we begin, before I hand it over to our wonderful moderator, I just want to mention a couple things. This is being recorded, and you will be sent the recording and the deck. So no worries. If you have questions, please put them into the chat. And we're going to be monitoring them. Sarah will be asking them after everyone's presented. Sarah will be asking them. And we we look forward to a really good discussion, probably very lively. And with that, I'm going to introduce Sarah Edelman, who is the Executive Vice President for Policy and Programs at the National Community Stabilization Trust. She has extensive experience in housing policy, including leadership roles at HUD, overseeing the FHA's single-family mortgage program, at Fannie Mae, launching the Duty to Serve program, and at the Center for American Progress, leading housing research and advocacy. And we are so honored to have her moderate, and we know it's been a really busy work week for her, so we really appreciate it. With that, I'll hand it over to Sarah. Thanks.
Thanks, Mary. It is wonderful to be here with you all and having this conversation today. As Mary mentioned, we've got a few great presentations for you today. I'm going to go ahead and introduce our speakers, and then they're going to go ahead and share the information that they have. I think the goal here, some of you probably know a lot about insurance. Some of you probably know that it is the prices are going up and it's a problem, but haven't had the bandwidth to focus much on it. So looking forward to just sort of having an introductory conversation and then a little bit of discussion. So first up, we're going to have Doug Heller, who's the Director of Insurance at the Consumer Federation of America. He's a nationally recognized expert on property casualty insurance. He brings 20 years of experience in public policy and regulatory matters, authoring research on auto insurance pricing, overseeing challenges to insurance company practices, and serving on state and federal insurance advisory boards. I can attest that Doug has been focusing on this long before many of us have started to realize what a challenge we have on our hands. Next, we're going to get to a different perspective. We're going to hear from James Fenneman from sort of a bit more of an insurance provider focus, and also a bit more focused on the multifamily experience or cooperatives and multifamily. James is an area executive vice president and senior director of affordable housing and construction practices at Gallagher. With more than 50 years of New York City brokerage experience, he focuses on developing affordable housing and construction opportunities across New York City and the Mid-Atlantic region. And then finally, we're going to go to Moira Burse. She is a senior fellow at the Climate and Community Institute, where she leads research on housing justice in the U.S. home insurance sector. She's also an independent consultant with more than 20 years of experience in climate and economic justice. human rights and public policy research in Latin America. So thank you to all of our panelists for being here. We are going to start out with about a 10-minute presentation from Doug and kind of set the stage.
Great. Thanks. Is that setting the stage or just warning me to keep on time?
Well, I realized I didn't tell people how long they should expect you to talk for.
Well, thanks, Sarah and Mary. Thank you all for having me. I am Doug Heller. I'm the Director of Insurance at Consumer Federation of America. And I'm going to talk today kind of providing an overview that I'll call sort of somewhat neutral on how the insurance market operates, a little bit about the insurance market and how it's regulated in the country. And then I'm going to talk about some of the research that Consumer Federation of America has been doing on homeowners insurance in particular. I know that a lot of you will have interest in other ways in which the insurance market is harming or challenging housing. And we've been doing more and more research. I mean, I think over the past quarter century or more that I've been working on insurance, there has never been as much focus on the intersection between housing and insurance as I've seen over the last several years. And so I'm excited with the opportunity with this group to talk about the different parts of it. But as I said, I'll focus a little bit on the home side. So next slide. I'm going to just give you a little overview of kind of the industry and the regulation. So first of all, for those who aren't as familiar, the insurance market in America is regulated at the state level rather than the federal level, with a little bit of touch from the federal, but almost all of it happens at the state level, which means there are 51 kind of different mechanisms for organizing the insurance market and overseeing it. Each state has a Department of Insurance, though it may be called the Department of Commerce or Department of Financial Services. There's an entity at the state level that is focused on overseeing the market, run by an insurance commissioner, again, sometimes called the director of insurance or something else. But these insurance commissioners are kind of the final authority on the market and overseer of it. And they have a trade association called the National Association of Insurance Commissioners, which you may hear some of us refer to as the NAIC. And that is a convener of discussions on policy and regulatory matters. They craft model laws and regulations and conduct research. And it really is kind of a fulcrum of the thought leadership and work that goes on in the insurance regulatory space in the country. There is a federal insurance office. It's not regulatory in nature. It was created during the financial crisis of the late 2000s. And it is housed within the Department of Treasury. That and though it's been a little dormant under this current administration, it does do research and kind of provides a window into the state insurance markets for federal agencies. Now, almost all states, with the exception of Wyoming and Illinois, which are largely deregulated when it comes to rates, all states follow this standard that rates, the price that consumers face in the market, shall not be excessive, inadequate, or unfairly discriminatory. And but the way that is overseen, enforced, and implemented really varies from state to state. There are kind of two broad differences that your types. One is what we call prior approval, and the prior approval states, which there's a small minority in the teens. These are states that require insurance companies to justify their rates to the commissioner and get approval before they can go into the market with any rate changes, whereas the other states have a variation of being allowed to use rates without a regulatory approval beforehand, though they have to file those rates with the department at some point in the process. Also, just want to mention with respect to the insurance commissioners, most of them are appointed usually by the governor, but there's a handful that are elected officials, statewide elected officials as well. Just one last bit on the market itself. As you can see at the bottom, I talk a little bit about the scale of the size of this market. The total property and casualty insurance industry, which includes homeowners, but also auto and workers' comp insurance, medical malpractice, and a range of other lines, took in about $1 trillion in premium in 2024, of which homeowners insurance is the second largest segment of the market. And that was about $163 billion in premiums that came in from homeowners around the country, and claims and losses incurred, or approximately claims paid out, were about $100 billion, which means the industry had about $60+ billion to cover its own expenses, its overhead, its advertising, and its profit. And then one last piece, important piece, that's going to factor into our discussion today is the property and casualty insurance market has a surplus of about $1.1 trillion. This is money that it's collected over the years in form of premium, but isn't allocated to any particular loss. It's there kind of as a final backstop in case there's a major disaster. There's money to pay claims. In fact, in the wake of the big Los Angeles fires at the beginning of this year, State Farm, which has about 15% or maybe 12 or 13% of that total surplus, they had to dip into their surplus to help pay some of those fire claims. What's important about that $1.1 trillion is that's really one of the primary drivers of the long-term insurance industry, the profitability of this insurance market. The industry doesn't actually really make money on its insurance transactions. It charges a premium for its policies. It eventually pays out claims. That number, the premiums versus the claims plus other expenses, approximately evens out over time. The real money is made by the insurance industry by investing the premiums and that surplus before a claims payment is ever needed. And that's really important because it will remind us that the insurance industry is driven by a cycle that has as much to do and maybe more to do with its investment income opportunities as with anything related to its actual insurance business. And I'm going to talk about that in a moment. Next slide, please. Most of you are probably here or interested in this because you are either feeling the pinch of the insurance crisis that consumers, whether they're homeowners individually or property developers, affordable housing developers in particular, are feeling that pinch. I'm not going to talk too much about that crisis. I think we know about it. It's been reported on. As I said, over my 25 plus years doing this, I've never had as much of a focus on the property insurance line as I've been seeing over the last couple of years. So I want to talk about where this is coming from, and I'm going to focus on three different elements of what's hitting the insurance industry and how that has led to these high prices and oftentimes difficulty finding insurance for consumers. So next, please. So one of the things that we cannot ignore that I think the industry did try to ignore for about a good 20 years is the impact of climate change on risk and risk exposure. If you look on the left-hand side, you can see the growth of natural disasters. These are all global data, but it's the United States is no different experiences this just in the same way. And you can see the growth over time on the left side, even though, for example, in 2005, we had Hurricane Katrina and Wilma and the others. So you see these pops once in a while, but just we've seen an increase in losses globally about fourfold in terms of average annual climate catastrophe, a catastrophic loss. And on the right side, it goes back all the way to 1950, and you can really see that exponential growth in the last 20 years. The top two lines I want to note, the top line is in purple, if you can see it. These are tropical cyclones, hurricanes and cyclones around the globe. I think that fits with people's experience. You can see the big line around 2005 with Hurricane Katrina. But the green line, which has that real clear exponential curve upward, this is severe convective storms. These are big windstorms and hailstorms. And it's important to know this because for all the attention that we pay to hurricanes which get named, and wildfires, which get wall-to-wall TV coverage when they're happening, we don't hear as much about hailstorms and windstorms, but they are the very close to the number one catastrophic loss in the insurance market over the past decades. And that's going to inform a little bit about what's going on in the US as well. Next, please. A second piece of this is the reinsurance costs. Now, reinsurance is the insurance that insurance companies purchase, just like we purchase to offload the risk that we have in the homes we own or the homes we build. Insurance companies offload some of their risk to it, but they do it on an unregulated global marketplace. And this just shows the chart of increases and decreases over the past 35 years. And what you see is that for the last 7 up until this year, those reinsurance premiums steadily increased for the insurance market to really the highest ever. And those costs get passed through into the market that homeowners and housing developers pay when they buy it, because the insurance companies just, not entirely, but often most of that reinsurance cost gets built into our rates. The last piece that I'm going to talk about here in the next, please, is the way the investments affect the insurance market. So you're seeing right now over the past 60 years, there have been 4 major insurance crises. There have been a few others that fit in a similar pattern, but not like the one that we have now, which you can see on the far right. But from the 70s and the 80s and the early 2000s, we had similar experiences with insurance crises in which the markets really seized up. It was hard to get insurance and the premiums went through the roof, as they have recently. And each one of those follows a dip on this blue line, which is the Federal Reserve's interest rates. This is really important because what happens, as I said about those surplus, that insurance industry model of investing our premiums and making their money that way as the primary sort of driver of profitability. When interest rates drop dramatically, it's harder for them to get the return when they invest in public bonds, corporate bonds, and of course, stock market volatility in these same at these same moments in time also make it harder for them to make their returns. If they can't bring in the investment income that they need to be as profitable as they want to be, on the insurance side, they really tighten things up. They make prices go through the roof, and it's harder to buy insurance. That's what we've seen right now in the wake of the dramatic drop of interest rates to basically zero after the pandemic. And that's what happened each and every time in the past crises. The good news is what we've learned from the past crises is as interest rates go back up again and the insurance industry sees an opportunity to profit through investments, they come back into the market, things soften, and hopefully we will see the same thing because, as everybody knows, interest rates have increased over the last couple of years, and the insurance industry returns have jumped back up to actually historic profits over the last couple of years. Okay, next slide, please, because what I'm going to do now is I'm going to borrow in just for a few moments into what the homeowners insurance market has been like for consumers in America. And we'll go through this kind of quickly. And obviously, if we want to talk more about the details during the conversation, happy to do so. So these are 3 reports that Consumer Federation of America has published over the last 2 years. And I'm going to start on the next slide with just the cost of insurance going up. So we looked at about 2.5 year differences over 2.5 years from the end of 2021 to the middle of 2024. And we saw that a typical homeowner in the country experienced a 23% increase on their homeowner's insurance, or about $50 a month in premium. But the most severe increases were in Utah, Illinois, Arizona, and Pennsylvania, though Florida remains the costliest state in America. As you'll see on the next slide, please, you can see the Gulf states with the hurricane exposure are clearly in the darkest, but the other places where you have the dark, meaning the high cost states, are in the middle of the country. And that's what I was talking about earlier related to that huge hail risk that goes and windstorm risk that doesn't get the same kind of attention as the coastal risks, catastrophic risks get, but really drive prices up. The other thing that's important to know is a lot of these Midwestern states, these really dark states, these are the states with the looser regulatory oversight, not the prior approval where insurance companies have to justify their rates before going into the market. And as an advocate working on this for a long time, our experience is that the states that don't have that prior approval tend to have higher rates and faster rate increases. The next slide, please, goes into a study that we did looking at the impact of credit score on homeowners insurance. This is something that most Americans don't realize affects their insurance premium. When they're surveyed about it, they're outraged that insurance companies even consider their credit score, since insurance isn't a loan, and if you don't make your payment, you get canceled. But what we found doing a data call for in every zip code in the country for the major insurers is that on average, somebody with a below fair credit score, kind of a lower credit score, pays about $2,000 more a year for a policy, about double what somebody with excellent credit would pay, even if everything else about those 2 homeowners was exactly the same. Even people with an average credit score, which on a FICO range is about low 700s, pays about $800 more a year. So that really is driving for lower income people who tend to have lower credit, one of the big pain points. Next slide, please. So you can see the intensity of it is shown by dark red, where the credit penalty is the worst. Only 3 states in the country, California, Maryland, and Massachusetts, prohibit homeowners insurance companies from considering credit score when setting premiums. Next, please. one of the really concerning things that we found in this research is when we aligned the impact of the credit penalty with zip code catastrophe or disaster risk. And if you look in this slide, the red dot is for somebody who lives in the least disaster-prone zip code in America, or among those with the low credit. And you can see that they pay about the same amount that somebody with excellent credit, that green dot, pays, even if they live in the zip code with the disaster risk that's at the 71st highest percentile of risk. And it shows a little bit about what the insurance industry is thinking about when they're thinking about risk, as opposed to what all of us as people who are thinking about their housing and their housing risk might imagine. So that's something that's a big concern and has been a great concern for us for a long time. Next slide, as we get to the last piece of research, we looked at a growing problem around uninsured homeowners. This data are from 2021. We believe that the numbers may have increased since then. But we found, using federal data, about 6 million homeowners lack insurance, representing about $1.6 trillion in market value. Next. And what we know is that these are not wealthy people who live on the coast and deciding just to give up coverage and protect themselves. Low income and impoverished homeowners are far more likely to be uninsured than those who are not in poverty. Next slide. This similarly, and unfortunately not surprisingly, shows the same for homeowners of color, also much more likely than white homeowners to be uninsured. And so next slide is just the final piece. Most of the people who are uninsured don't have a mortgage. These are homes that are paid off, or maybe were handed down from family generation to generation. And so their lender isn't requiring them to buy insurance. So they find themselves in that high price bind where they may give up insurance and leave their most valuable asset totally exposed. The few people, and this is how I'll wrap up, is there are few people, this 2% who have a mortgage but are uninsured. They are still paying for insurance. These folks have what's called lender-placed insurance or force-placed insurance, in which their mortgage company is charging them for an insurance product that only protects the bank. It only protects the mortgage company's exposure to the principal that's outstanding. So the homeowner pays for that coverage maybe on their mortgage bill, but they don't get any protection if their house is destroyed for themselves. It doesn't help them rebuild. All of this is a way to say that the homeowners insurance market, housing generally, is deeply impacted by the insurance market, the availability and the affordability of coverage, and that sustainable home ownership in America depends on addressing this deep-seated concern and these challenges that we see in the market. And I look forward to the conversation that we're going to have about how to do that. Thank you.
Doug, thank you so much for setting the framework for how insurance is functioning today. And we hosted our annual policy symposium this week and had a panel on insurance. And one of the things that came clearly through, and your research was referenced in addition to research out from the Fed, now new research coming out from the Urban Institute, is that while disaster risk is absolutely a big piece of this, the credit profile of the borrower is a huge driver. And so of disproportionate increases in insurance premiums. And so you've been saying that for quite some time, even before we had all of the peer-reviewed data showing it. So thank you. James, give us the perspective of how this is working in your practice.
Good afternoon, everyone. I'm James Fenneman, Senior Director of the Affordable Housing Practice of Gallagher, and Gallagher is the third largest global insurance brokerage firm with about 75,000 employees. I'm going to follow some of the activity of one of our large clients that we actually developed the program many, many years ago. It's called Urban Homesteading Assistance Board, and it's the nationally known organization that promotes the co-oping of formerly rental buildings, many of which went into city receivership and were renovated and now are stable with a portfolio of residents that have invested in their building. Gallagher, we negotiate and obtain the most competitive rates we can in the marketplace every year. And because of our size and our expertise in habitation, real estate, and non-for-profit businesses, we can get to just about every market in the insurance market in the U.S. Along with providing the brokerage services, Gallagher works closely with the organization, which is UHAB, providing leading seminars, consulting on loss control, discussing indemnification and prevention of labor law claims, as well as challenges of the New York construction, which refers to the New York State labor law. I'll briefly explain it now because it is probably one of the biggest cost drivers on the liability side. New York State is the only state in the union now that has an absolute liability that goes to the building owner for any construction accidents where a worker is injured. Could be the general contractor or a subcontractor. And it used to be from a height. It was originally called the scaffold law. Came out in 1883, when before workers' compensation. Most states started to eliminate this type of statute when workers' compensation came in, which is a no-fault system for all workers to be indemnified for medical expenses and loss of income. New York State kept it going, primarily driven by the plaintiff's bar in New York, and it is absolute liability. So there is basically no defense. And when you don't have defense, it's very hard to manage what the risk is, because risk is based upon the tort system, which is sharing the negligence. And we're not sharing the negligence, all going back to the building owner. So the building owner has to get the right insurance. And then if they have to hire a contractor that has to correct insurance.
Hey, James, can you talk a little bit closer to the microphone? Some folks are having a hard time hearing you.
I'm sorry.
Thank you.
Yeah, I'm sorry. So that if they don't, all of this burden comes to the building owner. And this is a crisis in New York State, and even more in New York City because of the amount of exterior work we have to do at an elevation on the buildings. Let's go back to the history in the partnership. It's 36 years, getting close to 40 years. And it started out small, and now it's close to 500 buildings. And it can fluctuate between 6,000 and 8,000 units per year. And it has been very, very stable, except we had a couple of years where we had some of these construction problems, and we have done an intense training program to get the buildings to the point where they're vetting contractors much closer, and it has turned everything around in the last 3 years. Okay, we can go on. We have a team of 10 people just dedicated to this program, and it's constant. We're working on life safety measures, rates, and insurance coverages. And for example, we'll do a whole program on e-batteries, which has become a problem on the fire exposure. There's been some very, very bad fires in New York with people bringing the batteries into their apartments with their scooters and their bicycles. Okay, we can go on. New York has a statute for affordable housing. It's called Housing Development Fund Corporation, commonly known as HDFC. And it's created just for this type of housing unit. And it started out in the 70s and really took off into the 80s. as we started to rezone in New York. Previously, commercial buildings became eligible to convert into residential. And we're actually going through that again now that we have a major shortage of affordable housing. And we have C buildings in non-traditional business neighborhoods being converted into residential. And that's a big, and this New York State is actually donating former prisons, former obsolete hospitals into affordable housing. HCFCs offer below market pricing and include maintain affordability such as income limits based upon percentage of AMI. There are various restrictions as to who's eligible to buy into these units. What our program offers to the buildings that join this program is education, training. UHAB has field staff that goes and visits the buildings and particularly educates the boards and shareholders on financial planning, having the proper legal documents, whether it's their house rules, which is very, very critical because a lot of insurance claims revert back to the house rules of the building. This is really important. This is the major initiative we did to cure the problem that we had about 4 or 5 years ago with contractor screening and vetting for planned capital improvements, major facade restoration, and minor maintenance work. New York has a law that every building over 6 stories has to be evaluated for potential loose masonry every 5 years and be certified. And if it needs work, the work has to be done in a timely manner. And that's why we have so many scaffolds in New York. Identity, and that's what prompts a lot of discussion about New York labor law, because when you're doing the facade restoration work, you have the most exposure from workers at heights. And life safety, which is a traditional making sure that people know what to do if there's a fire and closing their doors and not leaving them open so the fire can be contained to one particular unit. Okay, we can move on. Here are some tips that we have for addressing insurance needs in the multifamily commercial market. These are fresh. This is constantly in motion, but I'm going to outline a best practices tip for every type of insurance. Property insurance is most important to keep up with the cost of reconstructing your building. Currently, the estimated cost is between $300 to $450 per square foot, and that should be based upon the public records, which are, you can go on to Property Shark. There's a number of websites that provide that record, and that's the figure you should be using. And you should be applying it. $300 is about what a joisted masonry building is, could be a little higher. And $450 is up where a fire-resistant building would be. A lot of the housing stock in New York that's in the affordable housing range is joisted masonry, but we are now looking more into some of the larger Mitchell-Lama programs, which came out in the 1950s into the 1970s. And a lot of these buildings have a lot of challenges. Deferred maintenance that is building up and accumulating. And some of these buildings do not have the surplus to be able to absorb this. And UHAB is going to be working on some of these buildings where they used to work mostly on joisted masonry. We're going to be rolling into doing more work on fire-resistant buildings. With the correct replacement cost valuation, you are eligible for a guaranteed cost rider where there will be no valuation penalties. This way, you're going to be getting dollar new for old over the deductible, which in deductibles are normally between $5,000 and $10,000. Liability. I already opened it up because I couldn't wait to tell you how important the New York State labor law is. And we're the only state that has it. We keep trying to get it modified, but there just is not enough will in our state legislature nor with the governor. Just remember, it's absolute liability. The best solution would be what we call comparative liability. There is another law that goes with it, 241, which is for materials around a job site. That's comparative liability. So if the owner is responsible for a certain portion, the general contractor could be proportionally responsible, and the worker could be responsible. But we don't have that now. It's 100% against the owner, which is makes, once people understand this law, they just shake their head. No one can believe it. And it's been around for a long time. So what happens? Your liability. So once I mentioned it, you have a claim, someone gets hurt, they file a lawsuit against the building owner. The building owner gets the contract out, sees a hold harmless that the general contractor is responsible. They send it to the general contractor. In the meantime, their insurance company has to defend the case initially. If they have an exclusion for this kind of work, it gets denied. So then the building has to hire an attorney to put the original notice in. Then the general contractor's insurance company reviews it and sees, yes, we are responsible. We're going to take the tender over for the building owner. That means taking over their legal responsibilities. If they don't have the right insurance, it goes back to the building. So now we have a situation where the building may not have any insurance. The general contractor doesn't have any insurance. Now the building is fully financially and legally responsible to this claim, which starts at $1 million, can easily go up to $3, $4, $5 million. Many times this can put a building into a bankruptcy situation. So this is a real problem. And for years we had very affordable and available umbrella policies that would be up to $100 million for very reasonable cost, something like $40 per door per year, which is very reasonable. Now it's not available. Now you're down to possibly limits of 10 to 25 million, and you could be looking at costs of several $100s per door. So this is, if you wanted to talk about the biggest, hottest cost driver, is umbrella liability. And it flows to the primary liability. But because it's only $1 million limit on these policies, it doesn't have the impact that the umbrella does. Now to the good news, directors and officers liability is available and affordable. Should have at least $1 million in limit. There are several riders that go on, including employment practices liability. If anybody works in the building sues for wrongful termination or discrimination, you have coverage. And the main coverage you have here is for anybody who sues for being denied the ability to purchase an apartment in the building for any particular reason. This policy will defend and indemnify. And these policies start at about $2,000 to $3,000 a year for the bill, for a smaller building. And those rates have been relatively stable. And we suggest that when you're purchasing that coverage, you make sure that it's endorsed by one of the national organizations, housing organizations. And the final tip that I have today is your loss runs. We'll talk about your FICO score. I'm suggesting you look at your loss run score. It's not actually a score, but you get a 5-year history from the carriers for property and liability claims, and they'll identify when the accident happened, whether there is a reserve on the case, what was paid on the case, what the expenses have been. That could be legal, it could be investigative, and on a reserve and on a paid basis. You can look at it every year if you want, if you have some activity on some older cases. The underwriters typically look at 5 years. Some are even looking at 7 years history. So it's imperative that you have a full understanding of what happened in the building and what claims have been are accruing. And it goes by the incurred, which is the paid and reserves. It's not just the paid claims, because liability claims can take 3 to 5 years before they finally settle. And that's what a lot of the insurance companies' decisions are based upon, the loss runs. The other part is the inspection. Our program here, we inspect every building every 3 years to make sure the buildings are keeping up on all their maintenance, and there are any recommendations, they are curing them in a timely manner. So those are the two issues that insurance companies read and look at to evaluate underwriting of a particular insurance policy.
Hey,
Okay.
James, that's super helpful. You know, a lot of us have heard that affordable multifamily buildings have had a heck of a run over the past few years in stability of coverage, stability of, they're basically keeping their premiums relatively stable. What has your program's experience been with that? Have you also had have you been able to kind of keep things stable through all of these different tactics that you have on the, vetting contractors, et cetera, or are there factors sort of that feel outside of even your control when it comes to providing coverage and setting rates?
If you look at it on a long-term basis, which Doug has shown on some of the charts, or a better snapshot, it's been, I think, slightly below the market, and in some cases, quite a nice piece below the market, where we've been able to leverage some of the good experience. And unfortunately, we've had a couple of periods where we had some tough experience, and we may be above the market. Right now, we're finishing up a renewal. We predict we're going to be about 15 to 20% below the market, and we're going to be able to recapture a lot of the loss we had over the past 2 to 3 years due to a period. So when you look at it long term, it has that ups and downs. And some of it is, the fire that you couldn't, that was due to no one's negligence. And we've had fires that were due to people's negligence.
Yeah.
And the other problem with the liability we have is because of the tort laws and interpretation of our judicial system, this fraudulent claims are getting to be a problem. It's not just construction claims. We're having fraudulent claims and stage claims on trips and falls on the sidewalk. So people are starting to put cameras up. Job sites are getting to be, cameras are getting to be very, very common, to have cameras up to be able to catch and be able to prove that a case was fraudulent and staged. They're staged so much that the ambulance is waiting on the corner. And just happens to appear right
Hmm.
after the injury.
Well, thank you for sharing all of that and for responding to this impromptu question. So we'll have more discussion later, but Moira, let's kick it to you.
Thanks so much. Yeah, thanks a lot for this opportunity. So I'll just start out by introducing Climate and Community Institute. It's a progressive national climate and economy think tank, a network of over 60 fellows in academia and the policy world. And I've been leading a team researching the home insurance crisis as part of the organization's housing and climate work since 2023. And that's been in partnership with housing and climate movement organizations, policymakers, and other stakeholders. And from the beginning, we've really approached our work on this home insurance crisis from a housing justice perspective. And I definitely want to emphasize that when I say home insurance, I'm speaking broadly of insurance for all types of housing, from single family homes to affordable multifamily housing and everything in between. Next slide, please. So with that housing justice lens in mind, we titled CCI's original research paper on the topic Shared Fates for two reasons. And I'll flag that this is going to be a big zoom back to much more big picture thinking than we heard from James, and but bear with me. So we think about this as shared fates because of the collective nature of insurance, right? Which brings together many policyholders across different risks and geographies so that we're reducing the burden of risk for everyone. In a way, insurance like this is mutual aid. And also there's a collective nature of climate change, which, as Doug referenced, is a big factor in what we're seeing happen with insurance rates these days, although obviously James made clear it's not the only factor. But to really emphasize that climate change isn't going to spare anyone, even though the specifics of impacts may vary. So I'm going to talk a little bit more about each of these points before we get into solutions, because I think it's important as starting points to illustrate why at CCI we propose what we propose. Next slide, please. So, right, we expect insurance to protect us from financial ruin after disasters. But while insurance is like mutual aid in the way I described a moment ago, it's also a one-to-one contract, right, in which a policyholder pays in with the expectation of a payout if that housing incurs damage. Whether we're talking about these single-family homes, renters, condo owners, or housing providers, the expectation is that insurance will help recover the value of the home even after disasters. And yet, next slide, the profit-seeking structure of private insurance companies conflicts with this expectation that they will provide financial protection for policyholders. And that conflict is what gives rise to the insurance gaps that we're seeing, as Doug referenced earlier, and that leaves households and housing providers vulnerable. Next slide. So in response to the failures of the insurance industry in different moments, including some of the ones Doug highlighted earlier, the federal government and many states have set up insurers of last resort. At the national level, I'm sure folks are familiar with the National Flood Insurance Program, right? That's a federally run insurance program established by Congress in 1968 when private companies refused to underwrite flood risk. At the state level, we have what are called fair access to insurance requirement plans. The model for this was developed in the late 1960s as well in response to insurance gaps created by insurers' refusal to provide coverage in largely Black and Latinx inner city neighborhoods. So the federal government supported the establishment of these FAIR plans, or private insurer associations, with a temporary federal reinsurance program in order to incentivize private insurer participation. And in so doing, both federal and state governments have affirmed that home insurance really is an essential service for which backstops are needed when private markets fail. Next slide. However, while these programs have served as important safety nets for many households and housing providers, the model itself is not good insurance design, especially when it comes to big disasters, which of course, as we know, are increasing in severity and frequency with climate change. So there are a number of design flaws with this model. I'll expand upon a couple right now. First, these programs tend to ignore the basic principle of good insurance design, which includes spreading across types and levels of risk and creating broad and diverse risk pools. Instead, these programs tend to concentrate on only one type of risk, like flood or like wildfire, and only for the so-called riskiest policies. Some also intentionally push policyholders with what are believed to be less risky policies onto private market policies. Concentrating risk like this is kind of like designing a health insurance program that's only for stage 4 cancer patients. I think we all get that that wouldn't work well. Also really important to highlight is that these programs are often thought of, particularly at the state level, as state-run, run by California or New Mexico or what have you. But in fact, the vast majority of the governing boards of FAIR plans are dominated by industry representatives. And finally, the model isn't, as I mentioned, was designed for a really different purpose, and it is not fit for the kinds of broad market failures that we're seeing today. Next slide. So as we can see, reliance on the traditional home insurance models that we've lived with so far are really becoming more and more unsustainable under climate change. And they're also help to perpetuate inequalities that pre-existed this crisis, like housing discrimination that's played into insurance coverage. And of course, with the current federal political landscape, some of this unsustainability and inequality is likely to be exacerbated. I will move to the next slide. So what shall we do instead? I know the moment you've all been waiting for. First, it's really essential to start with clarity on our goal. For us at CCI, and arguably we would say for everyone, we think the goal should really be housing resilience and affordability for all. Next slide. So if that's our North Star, one more slide. There we go. So with that North Star of housing resilience and affordability for all, we've identified 3 keys for reimagining our home insurance system. 1, we've got to have comprehensive risk reduction. 2, the availability of equitable, stable, and affordable insurance. And 3, new and rebuilt housing in locations at least risk of disaster. I'll say a bit more about each of these now. Next slide. In terms of comprehensive disaster risk mitigation, this is essential to transforming home insurance because of the essential role that proactive risk reduction plays in limiting damage before disasters strike. Next slide. The availability of equitable, stable, and affordable insurance, right? We have insurance tools like risk assessment are uniquely positioned to support post-disaster recovery and increase resilience. But it needs to be available, affordable, and effective for all households and housing providers in order to serve those roles. Next slide. Actually, let's go back one. I want to say one more thing to number 2. Yeah, thank you. So we really think that coverage and protection from climate impacts and major disasters should embody principles of solidarity, safeguarding everyone regardless of socioeconomic status, race, or geography. Because while disaster risk affects us all, the burdens tend to fall heaviest on those who can least afford them. Yet, as I outlined previously, the profit protection conflict in private insurance markets will perpetually produce insurance gaps. And so at CCI, we really think that the only way to truly address this crisis is through a more public good approach to disaster insurance. Next slide. And of course, without the existence of sufficient, affordable, dignified, and safe housing, necessary risk reduction measures like relocation programs and stricter zoning in the riskiest places will further exacerbate our country's housing crisis. And so solutions to the home insurance crisis must be actively connected to policies to increase green, resilient, affordable housing in lower risk areas. Next slide. So at CCI, we've developed proposals for ways to transform the current disaster home insurance. And as referenced earlier, our guiding question is, what is the role of insurance in housing resilience and affordability? And I'll note here that what I'm about to share is focused on state level policy responses. That's in part because of the state level insurance regulation system that Doug explained at the beginning. We can imagine some of these principles applying at the federal level, but I'll leave that out for now for time and also given the current political landscape. Next slide. So our primary proposal to transform home insurance involves states creating entities, which we call housing resilience agencies, to run a state's housing risk reduction work and home disaster insurance provision with transparency, democracy, and equity. A risk reduction office under this agency would implement comprehensive disaster risk reduction and decarbonization efforts for housing, while a public disaster insurance program would administer single-payer, affordable disaster insurance for all housing types, including multifamily. In this model, we've envisioned private insurers would still provide the standard policies that cover things like kitchen fires, burglary, liability. This is akin to how New Zealand's home insurance system works. The HRA, next slide. The HRA would also facilitate collaboration with other state entities to ensure coordinated policy that increases affordability, availability, and resilience of housing and related infrastructure. Next slide. Of course, we have to think about how we pay for this, particularly at the state level. That's an essential question. We propose that those entities most responsible for the current climate-driven insurance crisis and those that would most benefit from stability in home insurance put skin in the game. When it comes to assigning responsibility, obviously fossil fuels are top of the list, but we also know, as Doug referenced, that the insurance industry long knew what climate change portended for housing and did little to solve it, and also continues to invest in the fossil fuel industry itself. When we think about the beneficiaries of more stable insurance markets, property lenders are an obvious example of who would benefit. Without insurable properties, their business model disappears. We could also think about how state HRAs could set up cooperation agreements with each other across states to pool resources, share risk, and provide mutual support during disaster. I will leave it there, but I very much look forward to your questions. If you go to the last slide real quick, yeah, folks can download the report using that QR code, and I'll also put a link in the chat. Thank you so much.
Thank you so much.
Oh, and can I say one more thing? I'm so sorry.
Go for it.
We are currently conducting research nationwide about how the insurance crisis is affecting affordable housing because of the really awful lack of data on these questions. We are doing interviews with developers, providers, lenders, and insurers, and we'd love to interview any and all of you who would want to share your experience and perspective. And we're particularly keen to interview insurers. James, I might ping you later, and also developers, providers in the South. So please get in touch if that's of interest to you. Thank you.
Great. Thank you so much. There's a quick question in the chat here about FAIR plans. I think, James, this is probably for you, but can you tell us a little bit of how the FAIR plan works on the multifamily rental side? Particularly, are you seeing the same kind of disparate treatment toward low income and people neighborhoods with higher shares of people of color as they did back in the 1960s? You're on mute.
Showing my age, but I remember when the FAIR plan came about, and it was definitely needed at the time. Since the insurance marketplace has a secondary market known as the excess and surplus market, that marketplace has come in and replaced a significant amount of the need that the FAIR plan had. So brokers can easily access that market. That market is called non-admitted carriers, and these non-admitted carriers, you're not eligible to collect under the statutory surplus if the company was to fail, but it is not always negative. There are positive things in this non-admitted market or the excess and surplus market where they do not have to file for form and rate. So they have more flexibility. It's true, it's more buyer beware, but it's offering a market that wasn't there. And the FAIR plan, the policy forms are very, very limited, just like the federal flood. Federal flood has a very limited flood form. There are much better private flood programs available, but if it's a very, very high intense flood area, it's usually not eligible. So the point I'm bringing out is, yes, the government has these facilities or quasi-government, but there is a private market that can take over and many times, most times, do a better job.
So,
Or do you mind if
yeah. Go ahead. They're going to respond. I'm going to ask one more question, and then I know this is supposedly an introductory call, but I'm looking at this list, and y'all know a lot about insurance. So we're going to respond to this. I'm going to ask one more and then open it up for other questions. So go ahead, Doug, and then Moira.
Well, I'll just be very brief. Moira has really studied this. Just two other pieces to add and kind of maybe a little contrast with what James said. One of the things with the FAIR plans, the commercial policies that are available for FAIR plans for housing developers, oftentimes there's a state limit in terms of the coverage that's available, both on the homeowner side, but also on the commercial. And so larger developments simply don't have access to enough coverage through the FAIR plans. So even where they may want to go to that because they just don't see anything in the admitted market, if you're a bigger housing development, you may not be able to get enough coverage. And I just wanted to put, as I think it was implicit in what James said, but maybe I come from a little bit of a different perspective about the use of these non-admitted carriers. Non-admitted, or sometimes called surplus lines or excess and surplus, is really a product or a market that's developed for sophisticated insurance buyers. We're really concerned about seeing it move into the actual homeowners market. And as James made the point, those policies are not backed by what's called the state guarantee fund. So if an insurer in the surplus line was to go belly up, if they were to become insolvent, unlike the rest of the admitted market, the companies that we all are familiar with typically, there is no backstop for claims payments. So if a carrier is particularly exposed in an area, if they have a surplus carrier has a lot of policies in one area, and they go belly up in the wake of a disaster, you may have a lot of housing developments or homeowners who don't have any way to get their claims paid. So that's a deep concern. And I think the flip side of the flexibility that comes with no regulatory oversight of the contractual forms and the underwriting rules and the rates that are charged is that you really do, as James said, buyer beware. You really need to have an expert legal team watching to make sure that the coverage that you're buying, that the coverage you think you're buying is actually the coverage that you're getting. We, especially on the homeowner side, or on, I think, the smaller scale without the real sophisticated risk management teams, affordable housing side, urge people to be very careful with the excess and surplus, the non-admitted market.
So. And Doug, to your point, in the this week I had a conversation with an organization in South Texas, and there's only one insurer that serves homeowners right now in their town, and they are not admitted. And so this is definitely making its way far from sort of the more sophisticated investors who might.
And also possibly concentrating the risk in an area. And if that one town that's relying on one carrier that's not backed by the guarantee.
Yes, exactly. Moira, go ahead.
Yeah, thanks so much. Just to build, so I shared in the chat a moment ago research that CCI published a couple months ago in October about FAIR plans, and it's a nationwide survey of FAIR plans. These are, to the last question, these are state by state. Many states have them, not every state does. We have some basic data on those coverage limits that Doug mentioned for every state that does have a FAIR plan, so you can check that out in the report. And just to name that, I mean, our original title for this report was not fit for purpose. We didn't end up calling it that, but that gives you an indication of our analysis of this program, and speaks also to what James said. Yeah, this was a measure set up in a really different time for a different purpose, and today with the kinds of insurance gaps that we're seeing, and the growing climate crisis, we need a different approach. And so our report gets into what that could look like in terms of FAIR plan reform. And of course, I shared some of our ideas for a broad strokes approach at the state level as well.
Great. Thank you so much. And that you all covered my follow-up questions. So I'm going to go into the chat, and others feel free to put the comment in the chat, or can they come off microphone too and talk? Or Mary, if you could just let me know in the chat.
Me too. Yeah, I'll let you know.
Okay. We have a question coming in from Alex Martin over at Americans Financial Reform about NFIP and how NFIP was created in a moment where the private sector was no longer serving these areas that were in need. Have we reached this point yet in the homeowners insurance market, particularly in areas like fire risk in California, where it's very difficult to get carriers in there to provide that coverage?
Yeah, absolutely. I mean, places like Florida, California that are so huge upticks in people turning to the state's FAIR Plan or equivalent thereof, largely because private insurers are not offering policies, and so they have no other choice. And so I think Alex makes a really good point, that this seems to be an indication that the private market is either unable or unwilling to provide for this really essential need, and so we have to rethink how we're designing these systems.
Sarah,
Did you want to say something, Doug?
one of the things that I've been saying a lot, because I've been with industry and panel discussions and a lot, and oftentimes they say, well, we had such a bad year last year, or how, we spend more than we take in premiums. And as I talked about earlier, that's not exactly how the business model works. It's okay when you do that, as long as you're making the investment income. But I think at a certain point, if the insurance industry keeps telling us that they can't serve our communities, we kind of have to take them at their word and not kind of just figure out, okay, well, what changes do we have to make to consumers' legal rights or the regulatory ruls to make it, to sort of fit that square peg into the round hole you say you find. But the other thing is, the last 2 years have been extremely profitable. 2025 and 2024 for both in the broader insurance market, $169 billion net income for the property casualty insurance industry in 2024, and the homeowners in particular. The problem is that the market is going to be, sometimes it's going to be really good for homeowners market. Mm-hmm. Sometimes you're going to have bad storms or bad events, and it'll be bad. And if the insurance industry refuses to sort of kind of deal with that up and down which is the nature of the property insurance market, especially in the era of climate change, then I think Moira brings up this sort of need to be reimagining it, because we just can't follow these cycles when it comes to things like home ownership, because it makes home ownership unsustainable.
Mm-hmm. Mm-hmm. That's really helpful. Let's just go ahead. If you want to ask a question, either pop it into the chat or just take yourself off mute and join us.
I'd like to bring up a point. I was on a task force in one of the severe availability and affordability crisis in the market. And I was brought down to Washington with a whole team. And we were actually laying out a rough model that the federal government would come in similar to what TRIA did with a non-natural disaster known as a terrorist act. TRIA originally only covered foreign adversaries, and then TRIA 2 included domestic, after we had some of the southern domestic, like the Oklahoma bombing case, for example, was the major case, one of those cases. But this was a natural disaster program where every commercial policy and every personal policy would pay, and I'll make it up, $1, or pay $1 per 1,000 or whatever the rate was. And then any area of the country that had a natural, defined as a natural disaster, mudslide, fire, wildfires, hurricanes, cyclones, ice storms, the carriers would then go to this pool of money that was collected, and that would level it out to everybody in the country, because just about everybody has some kind of exposure. Not everybody, just about everybody. And we just couldn't get any will amongst Washington. They said, that's states, we can't get involved. TRIA, we got involved is because that was a national disaster. It was not, I mean, not, it was a natural, not natural disaster. And it was so bad that terrorism was not available, and that was confining a lot of construction work because they couldn't get the terrorism insurance. And I was also involved in those negotiations. And I have to say, President Bush, in his wisdom, made it a labor bill, labor-oriented bill, which was more palatable to the Congress to get it approved. So I'm just throwing out some history that I was personally involved in, and maybe that's the kind of thought process that you folks are working on a national basis to see whether there's any will in Washington. I doubt you're going to find much in this climate we're in right now, and I'm not talking about natural climate. Maybe there will be.
So on that, if I could, Sarah, in 2024, then Congressman, now Senator Adam Schiff introduced the Insure Act, which was modeled in a lot of ways after TRIA. And the idea, to exactly your point, James, and I really appreciate what you had to say, when the Twin Towers came down and the commercial insurance market, property insurance market seized up around the world, government came in within 1 year to backstop Wall Street. I don't mean Wall Street, the money making, literal Wall Street, the ability to insure buildings on Wall Street and around the country. And with this effort that was unsuccessful a few years ago with Congressman, now Senator Schiff, the idea was, hey, we were able to do it, turn around a bill in 1 year to backstop Wall Street. And here we have a natural disaster crisis of, I mean, in the end, larger proportions in terms of the risk. And that Main Street needs the same kind of backstop. So I would just say that I think what, James, what you just laid out is exactly a way that the federal government could get involved by, and in fact, it's the way it's done in France. Flood is done that way in England. New Zealand does that. I mean, most of the kind of peer countries which have big exposure and disaster risk use some kind of federal backstop where the insurers and policyholders pay in to spread the risk around. In the end, insurance is meant
that would stabilize.
Absolutely. Yeah, I think we're in absolute agreement with that.
That'd be an immediate stabilization factor.
Yeah, and unfortunately, we have not been able to get the legislative moving yet. But I think it's exactly that that perspective that we've been trying to bring into Congress.
Because they have to TRIA, because
okay, go ahead, Maura.
Right there, I was right in the middle of TRIA. I was right in the middle of 9/11, and everything froze up, all the construction projects. But the policies that were in effect during the year from September to December hadn't gotten the terrorism exclusion until the reinsurance treaties went into effect in January, and that's when the world literally froze up. It was in January, and then fortunately it was in right up before Thanksgiving in 20. All
right, Maura, let's go to you.
Yeah, just a couple of comments. I mean, I think creative thinking like that is exactly what we need, and a couple of the additional factors to consider when thinking about a model like that is, as Doug mentioned at the beginning, there isn't federal regulatory power over insurance. And so when we're thinking about the kinds of ways that we want insurance companies to show up for individual clients and individual housing providers and individual homeowners, there isn't that kind of power to compel in the same way that at the state level exists. And so that's a tricky thing to work out that I think is different than an terrorism situation. And then also because so much, particularly on the homeowner side, but obviously not exclusively so, there is so much here that's about collective risk from these big disasters. It needs to be an approach that is taking that into account and doing risk reduction, risk mitigation, and not just thinking about how are we kind of keeping insurance companies afloat.
Yeah, no, I think that's a fantastic point. I am curious whether, you know, now that the government backs many millions of dollars worth of mortgages, and I do wonder if there isn't more of a hook than we might think, just given the amount of risk that they're at the end of the day the federal government is responsible for. Um,
Mhm.
let's go. So Amy Nelson has a question about accessing better data and whether the Illinois lawsuit on reporting might set a precedent. Anybody feel like they can take that one?
Well, I won't speak to the litigation that's going on
Yeah.
exactly. We'll see where that goes. I certainly think there has been a failure on at the regulatory level for decades in terms of data collection, and even in recent years, pressure brought by the public generally, by lawmakers and by advocates in the area of consumer protection and environmental protection and housing issues have created a demand for data from the departments of insurance has helped, but the departments of insurance have continued to argue that the data needs to be confidential. They're protecting the insurance industry even when the data don't reveal anything about the individual companies. It's really outrageous to me because we simply can't do the kind of research that is needed to help understand what will be the best policies. James, Moira, our organization have proposed things, but we're doing it without all the data that should be available. And as folks here who know home mortgage issues, the Home Mortgage Disclosure Act makes transaction level data available for every transaction in America. And we have so little on homeowners and even less on affordable housing projects in terms of what could be collected and should be distributed to the public for deeper research. So I'm hopeful that the Illinois litigation will lead to some opening up, but regulators themselves and all of you who work in different states who talk to your regulators should be asking them to make data about this market. And just the piece on that I think is important. When we talk about property insurance, this is not a kind of a free market. Anybody who has a loan is required to buy it. There is a constraint, a regulation, as it were, on the demand side. So we need to be more transparent about how the supply side works. So I certainly would urge us all to kind of get behind the move to make more data public so we can have better learning and better proposals.
That's great, Doug. Boyer, going back to something you were saying earlier, just sort of on the end in your presentation, the need to reduce overall risk by investing in risk mitigation and then hardening properties. Particularly, Doug, when you see your slide, hail, like we actually do know what to do about hail. Some of this other stuff is wildfire. You need to get the whole neighborhood to retrofit and to hail, like stronger roofs can really help. Um, but it seems like there need to be a number of conditions in place to actually have those retrofits translate into savings and stability of insurance for homeowners. And so my question is, in the long run, I hear everybody's long run vision, but in the short term, how do you make sure that those enhancements actually bring costs down or provide better coverage? I had a conversation with an organization serving home buyers earlier this week, and they went in hard on Fortified, and some of their homeowners saw their insurance premiums go up because it raised the overall value of their home and the cost to rebuild. And we see it in some states, it's worked super effectively. Alabama, they've actually managed to reduce premiums for folks regularly. But it seems like you need a bunch of things working together at once in a state for it to get where we need to go. And so I'm curious if you all have thoughts on sort of shorter, medium term things states could do.
Yeah, well, I mean, you hit on a really key point that I want to emphasize. I talked about it a little bit in my presentation, but these problems aren't just about an issue that an insurance commissioner can solve, right? It's not just a regulatory problem, although that is an important element. this is about a broad set of policy issues from land use and zoning to housing policy and beyond, right? That are all at play here. And so policymakers and advocates need to be thinking about this broad suite of overlapping and intersecting policies and how we can have them work together and communicate and collaborate with each other, right? So that's the big picture kind of answer.
Sure, yeah.
And and then when it comes to some of the specifics you named, I mean, I didn't add this to my presentation, but at CCI, my collaborators and I are very critical of this idea that the price of an insurance policy is a good way to incentivize risk reduction.
Mm.
That is a stalwart argument of the industry and unfortunately I would argue of many policymakers. But it is not very effective, actually, and causes a lot of inequities, right? So people make decisions about where they live for all kinds of reasons: homes, families, jobs, maybe housing discrimination forced them into a particular area. It's where affordable housing is or is not. And a lot of people can't afford, particularly if we're talking about say, a single family homeowner, you can't afford big, huge upfront costs of retrofits, right? We're talking tens of thousands of dollars for a new roof. And as you mentioned, Sarah, often, even if you can afford it and you do that, that doesn't necessarily translate to any kind of significant reduction in a premium. And so what we argue for is that the risk assessment tools that insurers currently use to say, oh, we're going to charge somebody a bunch more for their premium, that should be used to inform policy to say, here's where investment and risk mitigation needs to happen in this community, in this region. And then we need policy that supports that to happen, whether it's grants to do the roof, the new roof, whether it's, I don't know, a blitz where we send out contractors to a particularly risky, low income area and just everybody gets a new roof. There are lots of creative ways we can think about it, but the current system of saying, oh, well, your insurance price is going to go up and you gotta figure it out, is working, and it's extremely inequitable.
Yeah, no, I think partly what worked about the Alabama approach is there was a grant program provided with a requirement that insurers take retrofits into account. And I think that sort of combination, I just think it is interesting. And it'd be interesting to look more at in what instances do these retrofits actually pan out in terms of stability of coverage or rate.
I have a question for James that I think maybe you'd have some insight to, because as Moira pointed out, at the property level, at the homeowner scale, the home insurance premium, even a high premium, is a couple of $1,000s. Getting savings off of that for a $25,000 roof replacement, it just doesn't match up. But at the scale of larger developments where you're paying premiums that are tens or even hundreds of thousands of dollars a year, it may be that the upgrades are affordable in terms of if there's good savings and there may be enough savings. I'm wondering, James, if you see in the market insurers willing to give meaningful discounts when housing developers make the kinds of retrofits or upgrades that reduce exposure to loss.
Best way to get this done is to get it through the Department of Buildings and get it into the code. And everybody has to do it, and then everybody benefits in the better risks. Hurricane straps on roofs, typical example. Florida went through the whole, well, you don't want to buy a condominium in Florida because of Florida had this deferred maintenance policy. Buildings didn't have enough surplus. We know what happened with that tragedy. And now every building has to be brought up to code immediately. They don't have the funding, and many of these condos are in rough shape financially because Florida didn't have the necessary building codes required for the intensity of the weather conditions. So the Department of Buildings, put it right in there, everybody's got to do it, or they don't get their building permit, and they don't get their TCO or their CO, which they need to sell the property. And you'll immediately see the improvement in the losses, and you'll see everyone will benefit with potentially fewer losses and fewer premiums.
Elizabeth, I think we have time for one more question.
Expecting the insurance company to police it, they just
Right.
Yeah.
Elizabeth,
because
Yeah, this is more of a
it's very hard for them to do it because they can put it through as a recommendation, but it's not a warranty. Sometimes on certain policies, they can put it as a warranty. If you don't do it, you don't have coverage. You can't do that in personal insurance. The laws will not allow that. So it's
Mary, do we have time for one more question?
Sure, we have time for one more question.
Okay,
Thank
Elizabeth,
you.
go ahead.
it's more of a maybe more of an observation, which I've heard from sort of like the investment community, and this goes to what is the impact on properties if you improve their resiliency for the homeowners, and that if you have something that's done consistently, that also allows for maybe better packaging and pooling and being able to use that tradability of the asset at some point that can help support sustainability. And that, so some of these codes that are coming up are being like the roofs in Alabama and whatnot. There's a number of benefits and potential hidden value by having sets of properties that end up adhering. That may end up closing the idiosyncratic gap of, if you do that program, then your house gets more expensive. But if you've got neighborhoods doing it, that it's helpful. I think the other thing with Alabama that I learned is the reason that's such a valuable learning thing is again, the data. I mean, because they had the program, they had enough houses, and, unfortunately, a hurricane or catastrophic event that could give people data-based insights into that. I don't disagree with, different views on whether it's, there are better ways to do it holistically, or with the building codes, but the building code issue is one that's really difficult to tackle. And some of these on the ground improvements can make, a difference within a year of somebody, doing them. And so we definitely got a policy reality time gap coming up. But thank you for allowing me to just sort of put those observations. It's a really interesting discussion.
Thank you so much. And it does seem like there are some innovative data approaches underway to try and speed up that data collection. So hopefully that is a helpful tool. Thank you, everybody, for your participation and for our panelists for sharing these great perspectives. Mary, I will pass it back to you.
Thank you. And thank you all. That was a great discussion. And I think one of the things it points out is that this is an incredibly complicated and multi-stakeholder engagement, multi-policy arena. But I think the first thing is for people to get more engaged in it, because the more people know about this and know what are the policy levers, I think the better the decision making will be. And insurance has always been a little bit captive to the insurance industry itself. And I think the more advocates we have and the more people speaking up, the better. So I want to thank you again. The recording will be available. And if anyone's questions they still want answered, they feel like, please feel free to reach out to us or to the individual speakers for the questions. And we'll also have the deck available as well. Thank you. It was a great discussion, great moderating, and good luck and take care.